Navigating the markets doesn't require a screen cluttered with lagging indicators. Success comes from following a rule-based system designed to identify the specific traps set by institutional algorithms. Retail traders often struggle because they place their stop-loss orders in the exact areas where high-frequency algorithms look to build their own positions. These zones are known as liquidity. They represent clusters of resting orders sitting just above yesterday's high and just below yesterday's low, the exact points where thousands of participants have parked their exits. Once you can identify these pools of trapped capital, you stop being the source of liquidity for larger players. Instead, you can use those sweeps as a signal for a high-probability reversal. Start by opening your charting platform and selecting the 1-hour time frame. Examine the previous day's price action. You need to mark the absolute peak with a horizontal line for the previous day high and the absolute trough for the previous day low. Manually tracking these levels every day is time-consuming and leaves room for oversight. To streamline the process, go to the Indicators tab and search for previous day highs and lows. This will automate the levels on your chart instantly. Price frequently gravitates toward these two boundaries because institutional algorithms are programmed to execute orders in these high-volume zones. These two lines define your field of interest. Instead of reacting to every minor price movement, you now have clear markers indicating exactly where to wait for a setup to develop. As soon as price crosses one of your daily liquidity lines, move down to the 5-minute chart to watch the reaction. Wait for a break of structure. Price must reverse and close above its short-term high. This break is invalid if it occurs below the liquidity line. It must break above it. Also, thin wicks don't count. Candle bodies must close firmly above the high. These two requirements act as a filter against false reversals. They ensure you are entering based on a confirmed change in short-term buying or selling pressure rather than a temporary price spike. Look for a fair value gap, the empty space created when the first and third candle wicks fail to meet. Set your entry order at the edge of that gap. Place your stop loss below the swing low and target the opposite daily liquidity line. Even with a perfect technical setup, you still need a mathematical filter to keep the strategy viable over the long term. Use the long or short position tool to calculate your risk-to-reward ratio. This number, located in the tool's center, must be at least 2.5. If the ratio is lower than 2.5, pass on the trade. This threshold ensures that your successful trades are large enough to cover multiple losses, creating a mathematical edge even with a win rate below 50. That is the complete checklist. Establish 1-hour levels, wait for a 5-minute sweep and a valid close, enter on the gap, and maintain a 2.5 risk-to-reward ratio. Experienced traders often take this a step further by coding these exact rules into custom scripts, allowing the software to scan the markets and send alerts the moment the conditions are met. Open your charts and apply these daily levels to the last few days of data. Backtesting this yourself will show you exactly how frequently these liquidity traps occur. Profitable trading is less about predicting what happens next and more about executing a consistent system when the market reaches these key areas of institutional interest.